Hey guys, Toby Mathis here, and today we're going to talk about note and note investing and how it's taxed. So I'm not going to teach you the strategy of note investing. I'm just going to say that there's plenty of ways to get involved, everything from doing something like a Prosper to buying packages of notes, like doing a syndication that is loaning either to private equity or to Fortune 500 or to private individuals, whatever the case. It is investing in something called a note. And I'm just going to say that a note is a contract to pay interest on an amount secured by some sort of asset, real estate or perhaps shares or something else. But you're buying an income stream in all reality. And when you're buying a note, quite often it's like a mortgage. Like we're all pretty familiar with mortgages. Let's say that somebody writes a mortgage on a property for $100,000. And sometimes it's not being paid on time, or sometimes it's just being packaged up and sold. But regardless, there's the sale of the note, and then there's the income stream. So I want to talk about the taxes of those different types of income streams. But let's just make sure that we are focused on notes. So when you are investing in notes, or any type of activity, let's look at the tax rules. There's really three types of taxation. There's active taxes, active activities, where it's taxed at your ordinary bracket, subject to something called self-employment tax or Social Security, FICA, employment taxes. It's all underneath that heading. It's the old age, disability, and survivors and Medicare taxes, which are 15.3% when you break them out. And ordinary taxes is the more you make, the more they take. It's the 0 to 37% federal tax bracket, and then whatever your state is. So that's number one, is this active type of taxation. Area number two is portfolio, and that's where notes really live. Portfolio is, there's a bunch of different things underneath it. Capital gains is underneath it. Interest income is underneath it. You have things like dividends are underneath there. Royalties are underneath there. And the common denominator amongst all of them is that they are not subject to employment taxes. In fact, the only type of activity that is subject to employment taxes is active ordinary income, is that active income. I'm working for somebody, or I'm running my own business and it's me, a sole proprietor. I am going to have to pay not only the federal tax, but I'm going to get hit with that employment tax. When you go into the investment realm, you're really into the world of portfolio income, and you are generally not subject to employment taxes on those. But the two that I'm going to look at that you need to be aware of, number one is interest, and number two is capital gains. That's really what matters to a note investor. If you're an investor, now I'm going to use that term because I'm going to contrast it to where if you are in the trade or business of actively investing in notes. But just for our purposes here, we're just going to go over and say like you're an investor. So I'm buying a note, and I invest in that note. Let's say I put $100,000 in a note that's returning 7% a year. Well, when I'm receiving payments, I'm receiving two types of payment. Number one is the zero type of payment where there's no tax, which is the return of my principal. That's never taxable. The taxable event is when they give me interest. And if I pay that, or if I'm paid interest, it's taxed at my ordinary rate. So this is your ordinary tax. 0 to 37% federal. You know, you have your state too, but it's just ordinary tax treatment. And that's all you have to really remember is when you have interest coming in, it's, all right, I'm going to have to show that on my tax return. So we'll talk about how we offset that in a little bit. But when you're an investor, you're limited because you don't get to write off a whole bunch of deductions. I get to write off the interest expense. So let's say that I have a HELOC on my house that's 3%. I use that so I could go buy a note that's paying me 7%. I'm paying 3% on something. Let's say I borrow the whole 100,000, but I'm making that arbitrage in between them, that 4% spread between the 3% and the 7% I'm receiving, that's going to be taxable as ordinary income. The other type of tax treatment you sometimes run across is when you sell notes. I buy notes at a discount and I sell the note to somebody else. Now I'm looking at capital gains, and I have two flavors. I have short term, which is less than 1 year, and I have long term, which is greater than 1 year. And that's my holding period. How long did I actually hold it for? Short term is ordinary. Long term is 0, 15, or 20%, depending on your tax bracket. And it's just know that if you hold an asset for at least a year, then you get preferential tax treatment. That's also how dividends are taxed. But for our purposes of notes, we're just going to focus on the interest and the capital gains. Now, that's most people. Even when they invest in, say, let's say they do a syndication that is buying notes or is in the business of lending out to folks, and it's holding a portfolio of notes. When they're passing down that income, that's what you're really looking at is, am I receiving return on my principal, in which case it's 0? Am I receiving interest income, in which case it's ordinary? Did they sell some of those notes? Are they buying and selling notes? And are they selling them at a loss or at a gain? And that's capital gain. Now, the important things to remember whenever we're talking about these types of income is whether or not other types of losses might offset, or if these create losses, whether other types of income can be offset with it. And here's the general rule. Capital gains offset capital, or capital losses offset capital gains. So if you have capital gains in your note portfolio, but you lost money in the stock market, you could use the stock losses from the stock market against your gain from your note investing. When we're talking about ordinary income, the interest income, the only thing that's going to offset that is a non-passive ordinary loss. And this is where it gets really, really interesting. Because my experience with note buyers, my experience with those types of investors, and I am one, is that we also like real estate. And so a lot of times we're under the assumption that if I buy real estate and I create a passive loss in my real estate, I'm a real estate investor. I am not a real estate professional. I am not an active participant in real estate. I am just a plain old investor, and that's all I qualify for. And I have passive losses from my real estate activities, whether it be I bought single family, whether I bought a multifamily, whether I'm doing syndications and it's passing down losses or whatever. I have a passive loss that I cannot use against my note income. Now, there are two exceptions to that. If you are a real estate professional, and you'll know that by watching some of my other videos, if you are a real estate professional, which is 469C7 of the United States Code, you qualify. You're doing more than 750 hours a year. More than 50% of your time is in a real estate trader business. And you are materially participating with your rental portfolio. And you qualify. You meet their tests. There's 7 tests for material that you could qualify for under material participation. But you meet that, it unlocks those real estate passive losses, and all of a sudden, those could be used against your ordinary income. And this is really important because if that's you and you're a real estate professional, then you can offset your note income, that interest income, with your real estate losses. There's one other category, and that's called an active participant in real estate, where you are managing the manager. But my experience is that note investors usually are out of that category. Most note investors are making more than $100,000 a year, and that deduction is $25,000, but it phases out between $100,000 and $150,000 of adjusted gross income, $1 for every $2. So you lose that loss when you hit $150,000 of AGI. Now, I just bring that up because some of you guys, maybe you're in that $100,000 category and you're doing some note investing and you have some passive losses. If you're an active participant and all it takes is being in charge of firing or hiring the manager, you're actively participating, you're calling the shots, then you could create loss that offsets your ordinary income. And in that case, you're capped at $25,000, but again, every little bit helps sometimes in the tax world, but you should be aware that's the general rule, is that rents cannot offset your income that you're making in note investing. But there's two exceptions. That's an active participation and real estate professional. Now, let's go to one last category, and that is, what if my note investing qualifies as a trade or business? And that's not an easy one to hit. You have to show regular and continuous activity. You should have an expertise in note investing. It's what you're doing. They're going to look, do you have another job? Whether you're looking really to profit, are you living off those monies? It's almost like when we look at trader status for securities for a regular investor, we need to see that that is really what you do. And if that's the case and you qualify as a trader business, then you can get expenses, ordinary and necessary expenses, home office deductions, reimbursing of equipment. We may put this in a business, may use an S Corp and make you an employee so that we can do an accountable plan and unlock a whole bunch of other benefits. But that's what we're looking at, is like, can we start taking deductions against things? And then sometimes more importantly, if you suffer loss, like if you have non-performing notes or if you have to write off a note, then whether or not you can actually use that to offset your other income. When it's trader business, it's non-passive anymore, so long as you are materially participating in that business. And it really comes down to paperwork, keeping track of your stuff, making sure that you are showing how much time and expertise that you are spending in it. What's your, again, if I just got into note investing, it's not going to qualify. But if this is what I do and this is where I start making my living, and I show a requisite expertise and a profit motive, and I'm doing it regularly and continuously, then you may rise to that level. And I've met some folks that hit that level. That's how they make their living, in which case we are going to treat you completely different. So there's the investor side and there's the trader business side. And at the end of the day, they're treated differently from a tax standpoint. Hopefully I laid it out pretty clearly. You're on the investor side, it's going to be interest income, which is ordinary tax, not subject to self-employment taxes, or it's going to be capital gains. If it's on the trader business side, you're going to have ordinary taxation. You are going to be subject to self-employment tax unless you use a structure like an S Corp to minimize it. But you're able to use these types of losses off of that activity to offset other types of income. Otherwise, note investors that are making money, you got to look around at other things that could offset it. I'll give you just a few. So if you're a note investor and you're making good money and you're like, Toby, I don't qualify as a real estate professional. Toby, I'm not an active participant. I don't get that because I make too much money. What else is there for me? I might say, if you participate in another trader business that creates a loss, and I'll give you an example. Short-term rentals, Airbnb, I could create a loss. Even though you make physical cash, we could create a paper loss that could offset your income. We've actually done some videos on that one too. And that's a fantastic strategy. You could do things like oil and gas, where you have an intangible drilling interest and it's treated as ordinary loss in the first year. You could have any other business in which you create an ordinary loss and use that to offset your note income. That's your choices. So I hope I laid it out for you pretty clearly. If you're a note investor, now you know how you're going to be taxed. I know that sometimes this stuff gets confusing. Go back and watch it again, listen to it again, and then start digging and then have a conversation with your accountant. But regardless, now you know. Hope you got something out of it.